today's markets, investors are considering how to maintain the levels of returns that they've enjoyed over the last 10 years. Obviously, in these uncertain times, from the coronavirus to an election, it's becoming more and more challenging. So looking ahead, advisors are always asking, how can I achieve greater diversification, higher current income, less correlation? And oftentimes it's leading advisors to look at new investment strategies, including alternatives for income and growth. The challenge, however, is that there's lots of different strategies available, lots of different structures, managers, and there's no easy way to just go to one spot to find the best solution and the best way to utilize those solutions. So obviously the market is moving away from the traditional 60-40 rule of thumb for decades and decades a lot of people utilized. And we're here today to talk about the utilization of alternatives to achieve clients' goals, to reduce volatility, and to supplement clients' income in a zero interest rate environment. So I am pleased to welcome our panelists to the discussion. So I'm going to jump right into it. I would like everybody just to introduce themselves, their firm, and then we'll get into some of the Q&A. So Dan, why don't you kick it off?
Dan Z or Dan K?
Oh, that's a good point. Dan Z.
Sure. Thanks for having me today. Dan Zizniewski. I'm with a group called Humrickberg. We're based in Atlanta. We've been around for 30 years now. We manage just over $7 billion in assets, and we've been long-term proponents of alternative investments for our clients. And I'm a director in our investments group. So unlike many RIAs, I actually don't spend a lot of time interfacing with clients on a day-to-day basis. I sit on an investment team that's solely focused on research analysis and manager selection.
Great. Chuck, why don't you introduce yourself as well?
Hi, I'm Chuck Self, and I'm at Sumnick and Associates in Appleton, Wisconsin. I am the Chief Investment Officer of Sumnick and Associates, and Sumnick is a firm that deals with relatively high-income families and even some multi-family office situations here in Northeast Wisconsin. And so as Chief Investment Officer, I'm involved in the day-to-day choosing of the investments, and then we have investments across the board in all different asset classes, both domestically and international, including alternatives.
Fantastic. Daniel Kern, why don't you say hello?
Hello, greetings from Cape Cod. There may be some animal kingdom noises in the background. There seems to be a fever battle among birds outside of our house here. I am the Chief Investment Officer of TFC Financial Management. We are about a $1 billion RIA based in Boston. We are celebrating our 40th anniversary this year, which is I think we'll have to postpone our in-person celebration until the COVID pandemic is over. We do financial planning and investment management, primarily for individuals, although we do manage some money for endowments as well. In the past, we've had more of a focus on public markets, but in the 5 years or so that I've been with TFC, we've gradually moved more money into private markets and alternatives, and look forward to really increasing our footprint in the alternative space in the years to come.
Okay, great, fantastic. And last but not least, Brian Bueller. He's the President and Chief Executive Officer for Triton Pacific. Brian.
Hey, good afternoon, everyone. I'm calling in from Dana Point, California. So we are struggling with humidity. We're not. We're a private equity firm. We have a couple different verticals. The one that we'll have undertones of talking points on is our quick service restaurant vertical. And we are excited to be a part of this, and looks like each of the panelists are a target audience of ours. So appreciate the opportunity to share side-by-side screens with you.
Yeah, I'm also looking forward to learning more about, I guess the acronym would be QSR in the industry, and how somebody who's always, as a younger person, wanted to be a franchisee, but this might be a different way to get access to being a franchisee for Brian and his organization. So just to keep it on a macro or a broad level, just to get everybody kind of in the same direction, alternatives means a lot of things to a lot of different people. I've heard of people using physical hard assets as an alternative to liquid alts. So let me ask Dan Z, from a broad perspective, talk about alternatives, some of the, how you classify alternatives, how you screen for alternatives, and what your consideration is when you look for alternatives for your clients' portfolios.
Sure. So broadly speaking, we think about alternative investments as true illiquid alternatives. And when I say illiquid, we tend to invest in drawdown funds that can have, investment periods and terms anywhere from 5 to 10 years. We do invest in hedge funds as well, but we do not consider them true alternatives. And when we bucket alternative investments, we tend to think about them in sort of 5 different buckets. That would be private equity, private debt, real estate, natural resources, and then more opportunistic strategies that may not fit neatly in those other buckets. And so we do have a model portfolio within alternative investments. As I mentioned, I sit on an investment team where we each have, asset class expertise. I focus specifically on private equity, private debt, and natural resources. And again, I spend my time trying to keep the top of the funnel wide, meeting with managers, understanding different landscapes within alternative investments, whether private equity, private debt, and trying to understand, which managers we want to invest with, all the while sort of researching and bouncing ideas off of my colleagues on our investment team about what specific themes we want to target.
And to do a little bit deeper dive on that, is there any specific structure that an alternative would have to be in for consideration at your firm and your team?
Like I said, we do prefer truly illiquid structures. And we do see the merit in more liquid structures, but generally we like to have a closed-end fund structure because that's a good way of ensuring that the manager kind of, can take advantage of their own destiny to some extent, i.e. other people selling out won't impact your performance. So when we do talk about alternative investments, we do generally mean true illiquid structures.
Okay, great. Daniel K., you mentioned that over the last 5 years that you and your organization have started paying more attention, allocating towards and researching alternatives. Now, is that more of a function of the public markets becoming, having less security selection, or are you looking for a different return stream for your clients and prospects?
It's a little bit of both. I mean, it's certainly in part a function of the desire to have a different return stream. It's in part a function of so much in the public markets becoming more and more highly correlated. And I'd say the other dimension that's important is just the change in the dynamic. When I think about private equity and venture, companies are just staying private longer. And so the opportunity set has changed and really shrunk in the public markets. So we've really started to widen our opportunity set more. We, unlike Dan Z, our firm, because our firm doesn't really have a long-standing heritage in the private markets, only a few of our clients have invested in private markets prior to my joining the firm. So we've moved delicately kind of up the illiquidity paradigm. We've started out with illiquid but less illiquid strategies, if that makes sense. But gradually, I see us having a full continuum of things that go from limited liquidity to really long-term lockups.
Okay, Chuck, when it comes to alternatives, I know you mentioned international clients or international investing in that space. Can you talk a little bit about whether or not you and your organization use liquid, non-liquid, private, and then how do you screen for those solution sets?
Well, historically, we have used private investments. In fact, we were using them as early as the 90s. We've done a lot of research work, and we've decided that we can just as easily in today's market use liquid alternatives for most of our clients' low correlation needs. This was difficult even 10 years ago, but the ETF market has exploded in liquid alternatives. And so we have three ways in which we do this. One, we have a broad portfolio that includes hedge strategies, some real estate strategies, because a lot of real estate strategies have in the public market have high correlation to the equity markets. And then we have what are called alternative equity and alternative fixed income strategies, both of which are equity and fixed income strategies that have low correlation to the major benchmarks. We also have what we call inflation protection strategy that it has 25% in tips, which is not, of course, an alternative class, but then it has other type of assets in the commodity space that also would protect in times of inflation. Our number one strategy, we run 21 different strategies, but our number one strategy over the past 12 months has been our precious metal strategies. And this is where we invest in funds that own bullion itself, and they're gold, silver, platinum, and palladium.
Like
and
physicals?
Yeah, the physicals.
Yeah.
Yeah. They own the physicals. They're in vaults mainly in Europe, although there are funds in Australia, Canada, so on. Given what's happened in the precious metals market, those clients didn't have to be in equities because they did relatively well. And this is the thing that we have to deal with in the liquid alternative markets, is that there are times in which the correlation does approach that of equities and fixed income. But if you're a long-term investor, it adds diversification. And as we move away from 60-40, it's going to become an important, let's say, gateway drug into the alternatives area.
Great. Brian, I'm curious to learn more about the QSR sector. But before we kind of go down that road, can you talk to us a little bit about some of the clients that you're working with and why private equity makes sense? And where are we in the cycle with regards to private equity and liquidity, and how has COVID potentially affected, better for worse, the private equity sector?
Sure. So, Mr. Kern referenced the flow from public to private, and if you go back to 2000, 2001, there's close to 7,000 public companies, and now that's probably 60, 65, 70% less. That continues to be the trend is high net worth individuals, LPs, QPs, endowments, family offices, and multifamily offices are really looking for kind of a longer term relationship to their invested dollars or invested capital. So I think that's bode well for private equity. We've seen the amount of private equity firms almost double in the last 10 years. So as the public markets have shrunk, the private equity firms have, there's been breakaway teams that have started their own and breakaway teams from those that have started their own. So you've got this marketplace that's growing. And what we've started to see is that you take a broader approach, PE firm that is now focused on sector specific themes. So for example, within Triton Pacific Capital Partners, myself and my partners focus on a couple different verticals. One's healthcare services, one's specialty finance, litigation finance, and then quick service restaurants, or QSR. And that QSR particular sector has been interesting because of what's happening in the market. So to your question on COVID and how it can impact the thesis, every investment manager wants to be confident that their thesis, when tested, can come out performing well. And within different sectors, it's a mixed bag of returns. Within Triton's QSR portfolio, what our LPs are looking for is, first and foremost, they want to protect their principal. And so when we go to underwrite from an acquisition standpoint, our terminal value is the same price point as our purchase value. So we believe that we're going to create growth and generate a nice potential outcome for the investor. But if I'm buying at a 5.3 multiple, my exit terminal value is the same. So we tend to sandbag a little bit there. And it's really because the LPs have really sat down with us and said, listen, protect my principal first. Second to that, they're now starting to get more and more interested over the last couple of years, not just in the total return profile from an alpha perspective, but they're really focused on trying to create some yield in different ways to bring that to market within different structures allows for LPs to be pretty creative within their portfolio constructs. So within the QSR space, as you saw the market zig, QSR zagged, and when the markets were down 30–40% over the course of a couple of weeks, QSR was not immune to that, but the fluidity and flexibility of the QSR space allowed it to rebound almost 55–60% from the down level. So you're talking about a positive high teen digit to low 20s digit number compared to same store sales year prior. So I think whether you're on the investment management side as an issuer sponsor, you're an REA working to represent your high net worth clients, the one thing that we recognize is that without the permission of the LPs, it's really hard to make adjustments. And so we've been very thoughtful in the type of communication that we've had, our roundtable discussions we've had with some of our kind of REA thought leadership groups that we've created. And they've given us some good indicators of what they're looking for. And again, it's principal protection first. They really want to start to create some cash flow within certain alternative subsets of their allocations. And then obviously they'd like alpha, but the disconnect or misalignment is that investors, if they can get a 6.5%, 7.5% cash return year over year, they'll probably leave it in there forever. With REAs, you have to demonstrate an active managed portfolio. And so now you want to have exit strategies over the staged or laddered over the course of 3, 5, 7, 9 years. But I do believe that as an REA managing investor dollars, that actively working with a sponsor, having open dialogue, looking through the white papers, looking through the quarterly and annual reports, that you're demonstrating activity to the investor. And so I think that alignment kind of comes back together. So you asked a couple of different questions. I tried to cover them all. And it's really kind of a fascinating time that we're in. And when you look at the different sectors, there's some that definitely have advantages over others, and essential business related investment thesis right now tend to be very hot. So our QSR fund that we have available right now for accredited investors is escalating in capital raise on a daily basis because of some of those components.
That's great description of both. Answered a lot of questions as well. Dan Z, I know your organization, your firm deals with a lot of high net worth clients. Can you talk about the characteristics of a client who is number one, receptive to alternatives, and secondly, more specifically, private equity?
Sure. So I think there's two different components. I think first and foremost, they do want diversification away from public markets, and I think that rings true, potentially now more than ever. But two, they have to be a client that's willing to take a long-term view. In many cases, these funds have drawdown structures over 2 to 5 year periods. They have a J curve because you're investing the capital up front and paying fees on it, and you're not seeing the performance benefits until typically 3, 4, 5 years out. And in many cases, these are 10-year funds. So you do have to take a long-term view. So it's part of our job to be educational and telling them why they need to be investing in these asset classes, and particularly showing them performance of managers who have generated not just good absolute returns, but relative returns relative to public markets, or whatever the appropriate public benchmark is.
And is there typically a profile for somebody who is more receptive to private equity versus a liquid alt, or a shorter window with regards to an alternative?
Again, I do think that they have to have that element of being able to take a long-term view, but we definitely do have clients that sort of get it. And by that, I mean, they could have been a business owner themselves. They could have been a private equity-backed entrepreneur, and they may see the value that private equity firms could bring to the table. They may be in an occupation where they work with private equity often. They could be, a banker or a lawyer or an accountant, such that they have, or a consultant where they have that exposure to private equity, and they see that the resources private equity firms can bring to bear to add value to companies over long term.
great. Daniel K. So last 5 years, you've been much more active in the alt space. My question is, do you utilize private equity? And then secondly, where do you see current opportunities in the alt space based on your research and your due diligence? And,
So
and where do you see potentially troubling waters?
yeah, so we do have some clients who invest in private equity. It's a smaller portion of our client base than Dan Z's, but there's similarity in that it tends to be clients that want to be diversified from the public markets. It's clients that often have that same sort of fact pattern. Either they were business owners who were funded by private equity, or they were in private equity directly themselves, or they've had some experience in the private equity arena. The opportunities that we've seen for more of our clients, the common theme is the clients wanting to diversify away from public market volatility. And so we've had success with clients who've been interested in insurance-linked securities, things like quota shares, that completely operate independently of the capital markets. We also have a fair number of clients who are in private real estate vehicles. We really run the gamut there from more liquid, core leased income-oriented properties to longer term, less liquid, more development, core plus real estate strategies. And that tends to, the clients that are doing those longer duration, 10-year life cycle properties, again, tend to be clients that have had some experience with real estate before. So they're comfortable with capital calls, they're comfortable with a longer stretch of time for the return of their capital.
And similar question to you, to Charles. Is there a typical risk profile for your clients that are comfortable with private equity and or other alternatives? And then
Yeah, in most cases, oh, go ahead, I'm sorry.
what percentage of your typical clients' portfolio has alternative exposure?
Okay, yeah, there's really three types of clients. One who can take the volatility of the equity market, and over time, the equity market is the best place to be. And if the client can take that volatility, then it's 100% in the equity market. At the other end, there are clients that have income limitation, and so and they want income from their portfolios, and so they tend not to be a client of the alternative side. But then there's the in-between, people that historically have had both equity and fixed income in a portfolio. I spent the first 20 years of my career in institutional fixed income, and I'm sorry to say that the 40 of 60-40 is going to die. And I don't know, there'll be a wide range of public and private types of instruments that people could use for that. But if we had this panel 5 years from now and it was 60-20-20 was the what was people were doing, that wouldn't surprise me at all. So we also have kind of a fourth group of people who have that don't have businesses, they don't have real estate, and so when you look at their total portfolio, it's very much securities market oriented, and so they tend to have it. So like I said, I think 60-30-10 is going to be the new benchmark going forward, on its way to 60-20-20. And our view is, if you're not going to put 10% allocation to portfolio, why bother? It's just not worthwhile. So we will only do it in portfolios that can take 10%, that need 10%, and we'll want to stay long-term with that type of allocation through thick and thin.
Right. And Brian, based on your knowledge of your clients who invest in your private equity funds, specifically maybe the QRS, can you talk a little bit about what profile you know about them? And then secondly, I mean, clearly the wind has been at the back of private equity for the last 10 plus years. Based on your experience and your opinion, are those returns repeatable? And then, and really, why is private equity so advantageous to a high net worth client?
Yes, thank you. So the profile for Triton is kind of threefold because we have three very distinct channels that we're raising capital in. So our family office channel has a very distinct profile that is quite different than the mass affluent accredited investor. So the family profile is one where in a capital call format, they're looking at minimums of $10 million allocations. They typically are clubbing in with some other family offices to get to larger amounts to work directly with us. With the other two channels, you have the independent broker-dealer channel, which we've been raising capital in since the mid-2005 range. And then the REA channel, which represents about 30-35% of our equity raise source, has been over the last 4 years. And that profile is a little bit different than the IBD, where they're looking for two things. One, again, principal protection, and then they want cash flow. This is a group of high net worth investors that are aging, and they need to start to rely on their principal working for them, not taking principal down. And so those profiles, I think, will continue to shift. We've made a focused effort since 2015, and one of the pillars we have in our organization at Triton is that private equity should be available to the mass affluent. Another way of saying it is that we're trying to democratize access to private equity. And I think today was a great example of that, with the SEC changing the accreditation standards just slightly to allow for more democratization of different types of alternative investments, one of them being private equity. So the way that we structured our current offering for the IBDs and REAs in particular is through an LP structure where it's not a capital call focus. They're investing with subdocs electronically or physically, and they go into the fund. The fund then utilizes those dollars to go make acquisitions, and in trade, the client is expecting to get some type of a distribution, and then within a 3 to 5 year hold, have some type of a full cycle event takes place, whether it's a recap, whether it's a strategic sell, or some combination of the two. So I think those are kind of different dynamics depending on the type of profile source that we're talking about. In terms of private equity, being able to duplicate its efforts over and over, I think as we see the alt market get smarter and tap into different types of sources of capital, I think you're going to see very creative structures and ways to align themselves with the investor through a financial advisor, a fiduciary like an RIA. So when you look at how to duplicate performance, that's a great question. We tend to be very sector focused, so we're not a broad fund of funds. We're not a feeder fund structure. It's an LP focus that allows investors to come into a fund alongside other retail investors, passively participate in an investment. So to make it more relatable, if you're driving down the road and you see Burger Kings and Pizza Huts and you went, man, I wish I would have invested that, but I don't want to quit my day job, learn how to flip burgers and fly pizza pies. This is a different way to make an investment, similar to maybe REITs, where you drive down the road and you go, man, I wish I owned part of that office building. Instead, you can access it through REITs. So I think the access is going to change the performance profile, but I think the more you get focused on sector or niche sector specific investments, you have a better opportunity, I think, to outperform more of the generic broad-based thesis that are out there. And I think we can point at a lot of different studies that will demonstrate that fact. And so we tend to be more sector focused so that we can outdrive results. So in our QSR vertical, we're trending about 3.5% to 5% better than the QSR average within that space. And then if you drill down more with particular geographic regions within a sector, then we're outperforming by a much greater margin. So Time will tell if we're right, but so far, coverage of distribution is right now 1.94 to 1. So I have almost a 2x on my current distribution rate that's going out to the investors on a quarterly basis. So we've already achieved our total return profile on the offering, and we're still raising capital during the offering. So it's in the QSR space in particular, I call it a pennies and seconds game. If you're not counting every penny and watching every second, you're probably going to have slippage. So we care very much about the quality of service, speed of service, and increasing the margins so that ultimately at the fund level, we can generate a return that's right-sized for the risk parameters for the LPs that are coming into the fund.
So how big is the QSR market?
QSR market represents about 500 billion in revenues annually, so it's pretty massive. When you look at the QSR space, there's just under 300,000 store locations just in the US alone. Within the Burger King and Pizza Hut systems, our offering or our firm is number 8, number 10 in North America in terms of our operating status, if you will, within those brands. I think there's a massive fragmentation that exists within the QSR space. And what you're seeing within that particular sector is a mismatch between the current owner and the beneficiary or son, daughter, niece, nephew of the owner that they don't want to inherit it. They want to cash out. Thanks, mom and dad, and let's sell it, get the cash, and do something with it. So another way of saying that is there's a tremendous aggregation play, and there's a ton of money chasing it. But the main barrier to entry isn't dollars; it's the operational ability to execute on a daily basis within that space. So we think we're poised well with our operating business structure as a store level operator, and so we will be in this space until the math doesn't make sense. So we think there's a good kind of 5 to 7, maybe 7 to 10 year run here to aggregate several $1 billion worth of QSR allocations over the course of that time frame.
Interesting. Cool. Dan Z, you mentioned earlier about how you and your team are somewhat sector focused. Can you talk a little bit more about the have and have nots? What's working, what's not? Where are you shying away from when you get those calls or emails about a specific area within alternatives?
Sure. So a few areas we do really like. We've had a thesis on software for the past few years that has really come to fruition during this COVID downturn. Obviously, we're increasingly reliant on it. But we really just love the dynamics of those businesses. They tend to be recurring revenue, repeat customers. They're mission critical to the businesses they serve. And I think everything that we've just gone through sort of highlights that. We like healthcare services historically as well. Again, typically very recession resilient, but obviously COVID has thrown a wrench in everybody's plans, and even some sectors within healthcare services that we thought would never shut down have seen dramatic impacts to their business. Mm-hmm. Some areas that we've been staying away from, I think we won't be allocating to energy anytime soon. I think coming out of the first downturn in sort of 2015-16, you would be able to buy assets at really attractive valuations, and even if prices sort of moderated quite a little bit, that you'd be able to generate some attractive returns. But that's as an industry that we keep seeing very volatile swings in, and now you have some very serious headwinds against the industry in terms of ESG and renewables and things of that sort. So I think that's an area that we're going to be staying away from for the foreseeable future. But other areas that, luckily we didn't have a lot of exposure to going into COVID were things like, leisure hospitality, retail, consumer-focused businesses, or really a lot of B2C businesses, frankly. So those are some areas that we sort of like and don't like, but we typically look for companies that have more visible contractual cash flows to the extent that we can find them.
Interesting. And then similar question over to Dan K. Can you want to dive in a little bit more with specifics of how you're allocating capital and where you're not allocating capital?
So one of the places that's interesting to us is alternative credit, and really playing on the theme of credit disintermediation. The panel before us talked about illiquidity premiums,
Mhm.
but I also see in the credit space complexity premiums, and it's small niche type opportunities in the credit space, whether it's litigation financing, receivables financing, some bridge debt with pretty low loan to value structures. There's some opportunities there that are interesting, even in a close to zero interest rate world. So that's interesting. On the real estate side, I looked at a deal this morning in the assisted living space, which I think is potentially a huge grower if managed properly. And looking at those operators that managed through COVID, through the first phases of the COVID crisis successfully versus those that haven't, there's an opportunity. I think there's some opportunities there. I would agree with Dan Z on the energy space. I think there's still a lot of potential carnage there. I think that there are still a lot of zombie exploration and production companies that really should disappear. There should be consolidation in the energy industry, but until we see signs that that's actually going to happen, that's a part of the market we shy away from. The other area that's controversial, but interesting, is the hospitality space. I'm seeing some private equity players get involved in distressed hospitality, and there will be, I think, some interesting opportunities there. Big potential winners, but also big potential losers as travel habits change. But I think there are opportunities there. Too soon for us to do anything there, but it's an area that we're watching. And for certain clients that are comfortable in that space, there may be some capital that we end up deploying there.
It's very interesting. So when you mentioned hospitalities, interesting opportunities, are these knives that have already fallen, or they're in your estimation will fall at some point?
More in the realm of knives that will fall. I think they're feeling the pain, but we're not quite at the level where the knife's fallen as far as it's likely to fall.
Right.
So the wild card in all of this, or in a lot of this, when you think about distressed investing, is where are the spaces where the Fed or Congress are going to step in and keep companies on life support that maybe should go under, and figuring out where companies are likely to be kept alive and where companies are more likely to fail. I think that's a dimension in this as well. Brian and Dan Z have talked about sector specialization, and I think that's critically important. But I also think there may be more opportunities among small and mid-sized companies in the private space than among the larger companies. I'm a little worried about the amount of money from the big private equity that the big private equity providers have to deploy, and what valuations look like in that space, and what it looks like when you've got 5 or 6 very gigantic companies chasing the same deals. Just one quick story. About a year and a half ago, I was in New York meeting with a major private equity firm, and there were 6 client-facing people in the room and me. Nobody in the room with me who's anywhere near being involved in the investment decision, but 6 people who are involved in sales and client servicing. And that tells me that at least some of the big players are more about asset accumulation these days than about asset management and growing returns. So I think that's a red flag for me.
Yeah, I've read numerous articles about how the top 10 private equity firms have amassed and continue to amass huge war chests. And when they go to deploy them, I mean, I'm not an investment professional, but they are not going to be able to allocate, nothing less than $1 billion on a deal or something to that effect. where they can actually make a difference to their fund and to their stakeholders. So you may be looking under the right, rocks, the small and the mid-sized stuff versus trying to chase the big dogs who are going to push valuations to stretch them to the end, because eventually they're going to have to deploy the capital. And then Chuck, I'd be curious to see what specifically you're focused on right now with regards to where you're seeing good opportunities and what you're recommending to clients on a going forward basis.
Well, there's a number of sectors that we think are interesting. We think precious metals still continue to be interesting. Unlike most other tradable assets on an inflation-adjusted basis, they're not at their highs, and again, they have over time zero correlation to equities and fixed income. And so, and in fact, a little known fact is that if you looked over the past 20 years, precious metals has outperformed even equities. So it's been a good diversifier, and we think that unlike bonds, it's going to continue to be a good diversifier. Previous people, I think, was Dan Kay, talked about energy, and the one place where we think there's great values is in the pipeline area, the mid level energy areas, the pipeline and storage. We saw last year where Cushing almost ran out of storage and energy, and so clearly our infrastructure, as we're going to go to more natural gas, especially, our infrastructure is not there, and whatever you have is good. And so it could be a volatile ride with anything with energy, but when it really comes down to earnings and dividends, the vast majority of them are going to be able to keep it. And then I have to also talk about credits, since I started as a bond guy, and the previous panel talked about BDCs, and we think there's a secular story in BDCs that is attractive as the banks raise their credit abilities, and the small local banks can't do it. So there's this big piece in the middle, and the BDCs are a great place. We have invested with Monroe Capital, actually. I know some people there, and so we think investors should look at that if they're really concerned about, or if they really want yield, because they're double-digit yields at this point.
Right. Yeah, interesting, very interesting sector. I think there's going to be a lot more to be written about private credit on a going forward basis if global rates remain around zero. And I also think it bodes well for innovators in the private equity world, like Brian and his organization, where they essentially are monetizing cash flow from from Pizza Huts and Burger Kings and the like. So Brian, shed some more light about how the cash flow works and how one takes advantage of it.
Well, it starts with the average American, and 84 million Americans visit a fast food restaurant every single day pre-COVID. During COVID, it's spiked dramatically, and the numbers haven't really fully been vetted, but north of 100 million consumers every day. So when the grocery shelves are challenged and your favorite restaurants temporarily closed, or you don't want to sit out on the parking lot and have a meal, because it's interesting at best. You go through fast food, and I look at, full disclosure, I'm a vegan, so I don't eat any of it, but I sure like to make money. So when you look at kind of following the dollar as it goes, consumer starts with the consumer, and then from there, from an investor standpoint, dollars come into the fund, dollars are allocated out for acquisitions. We have a very I think unique way of going about the QSR space from a top-down approach. So with Burger King, for example, we're one of 8 strategic partners globally. So we've been fully vetted by Burger King. We've vetted Burger King and come to an arrangement where within certain areas of the country, we basically have a first right of refusal on deal flow. And if we're the largest operator within a tri-state area, are you as a potential competing buyer going to come in and have a chance? And the answer is probably no. And so we get into a lot of non-competitive purchase environments because of that. So as the store volumes increase in sales, and that's due to two things. One, us trying to be a great operator. And then number two, instead of taking dollars to service debt, we take dollars and re-image the asset or redeploy capital for digital menu boards or second lane drive-throughs so that speed of service is increased, et cetera. We're able to then increase our overall distributions to investors. So if I'm permitted to talk about distributions, for example, in 2019, our stated distribution yield to REAs was 7.5%. And we made an additional 150 basis point distribution at the end of 2019. So the LP investors that came in through REAs saw a 9% fully covered distribution. That's a good distribution rate that we're very proud of, given the parameters that exist around this particular thesis. So when you think about sector specialization, there's some benefits that come from it. Beyond just the cash flows, it's the working knowledge, it's the relationships, it's the networking, it's the lending relationships, and then top down from the franchisor, they're really driving deal flow to us as a large operator within a sector versus a small mom and pop that, yes, a small operator may want to come in and buy one or two stores, but we're looking to buy hundreds and hundreds and hundreds of stores, operate those stores more efficiently, which ultimately the parent franchise company of Burger King, RBI, they have to post increased revenues on a quarterly basis, right? So do they want to partner with a private equity firm that's going to drive results faster? Or do they want to partner up with thousands of small owner operators? So again, I think as an aggregator, there's a tremendous opportunity within the space to consolidate. And as you follow the dollar, again, it all starts with the consumer. And so it doesn't matter whether markets are up and down, people need to eat. The only difference is when the markets are down, people eat less expensively, and that's where QSR really fits in.
So it sounds like it's a fully integrated solution from not only operating the private equity firm, but also running the operation lean and mean and effectively. So it's definitely something to consider. I want to, we have about 5 or 6 minutes here. I just want to circle back to Dan K. Dan, talk to me about what keeps you up at night with regards to markets and specifically private equity. Specifically alternatives.
Well, there's a lot of things that are keeping me up at night these days.
Yeah.
But I think on the alternative side, it's really not a lot different than what keeps me up at night in the public markets. It's where are we in terms of progress against COVID? Right. Whether you're talking about the public markets or private markets, that's it's a game changer for economic growth and for public health. There's a whole policy dimension to the equation that we really haven't touched on, but policies with regard to COVID, what happens in the election? Do we have conclusive results in November with the election? Who becomes president? What happens to control of the Senate? There are dramatic implications for public and private markets, and certainly the attractiveness of private investments could change fundamentally depending on what the November results look like. So is that enough to get us started in terms of a wall of worry?
Yeah, exactly. And Dan Z, I'm curious how you're setting expectations for clients with regards to alternatives, since we've had a 10-year hurricane at our back with regards to returns, both from a private equity perspective as well as liquid markets. Are you talking differently and setting expectations differently with clients when it comes to the asset classes that you and your team analyze and allocate towards?
Sure. So yes and no. So over long periods of time, which we think is it's very important again to sort of take that long-term view when allocating to alternatives, we tell clients that you should earn an illiquidity premium again over that long period of time. And we typically think of that as sort of 300 to 400 basis points. And so, we think it's also difficult to market time alternatives to some extent because again, they are 10-year views. And frankly, I can't tell you what the exit environment for private equity is going to be 8 years from now. So we do, to some extent, encourage clients to sort of keep a steady allocation to different areas. But that said, there are sort of fat pitches in the market or areas that are obviously attractive at certain points in time. So as an example, in the depths of March and April, we were actively allocating to more distressed opportunities, which we've since pulled back on a little bit. So we do think that it's important to keep that long-term view in mind, stay on your financial plan, and have alternatives that sort of align with that. But we do try and be tactical as well, to the extent we can.
Okay. And is there anything specific that that you've seen recently in the alt space that's gotten you worrisome? Are there too many people looking for the next home run grand slam, or do you think just give me a sense of what might worry you in that sector?
Sure. So in private equity, we have been concerned about valuations for a long time, frankly. But some of the other elements, again, given the success of the asset class, we've been concerned that managers are coming back to market too quickly. They are raising too big of funds. And frankly, that's my job to understand, dig under the hood, make sure, one, are they sticking to their sweet spot where they've generated their success? Are they required to, are they earning the returns on leverage versus true organic and M&A growth at the company level? And some of the themes that other panelists have talked about, which are areas that we like and we think kind of exist during all market cycles, is sort of a middle market or lower middle market focus. We like buy and build strategies or M&A. We like very large fragmented industries. So that's some of the themes that we've always invested around. And we think that makes sense regardless of where you are in the market cycle, but there definitely are areas of concern as it relates to coming back to market too quickly, raising too much capital, exhibiting strategy drift, and things like that.
Yeah, it's interesting. There's a lot of money. The equity markets have rebounded nicely since March and April, but there seems to be a considerable amount of money still being deployed, both institutionally and high net worth in the alternative space. And then, Chuck, do you want to leave us with some final thoughts about your outlook or your sense of worry?
Yeah, what I'm most worried about is the macro picture. I don't think any of us understand exactly how the world is going to be different 2 years from now, or even 5 years from now because of this. Because we have inflation protected types of funds or investment strategies. We have commodity investments in it. Who knows what the commodity market is going to look like?
Right.
Any of them. We're talking about meats or softs or energy or whatever. So it's I don't worry about it because I can't do anything about it, but it's what I'm concerned about. I'm concerned about managing risk. I don't know where the return is going to come from, but I can manage risk. And so what I tell on almost all these kind of panels is that it's likely that if you're an RIA or any type of advisor, your clients are under diversified, given what's going to happen. And whether you use public liquid alternatives or private alternatives, you must more fully diversify your clients' portfolios. And if you don't, you're going to, on the investment side at least, lose out.
Yeah, definitely. I agree with you there. And then finally, I just want to wrap up our panel discussion here with Brian. I would love your kind of final words, your thoughts. I know you're a big thinker. You and I have spent some time together, and I'm curious, and more importantly, get a sense of what people are thinking about getting recurring cash flow from a less obvious asset as you drive past it on a consistent basis, or actually go to it on often your kids or yourselves, not you because you're the vegan, but nevertheless, here's a way to capitalize on what people do day in and day out, close to 100 million U.S. citizens. So final thoughts, Brian?
Think twice, act once. It's a theme that resonates throughout our household. From an investment standpoint, let me rephrase it and say it's very easy to make investments.
Sure.
It's harder to create an exit. And so I think it's very important to hold your sponsor issuers' feet to the fire, ask the hard questions, look at the financials. One of the other pillars that we have at our firm beyond just democratizing private equity to the mass affluent is transparency. And under an NDA, I'll give you any document you want. And I think that's a very unique proposition for private equity firms to offer, considering it's been this black opaque box for so many years. And so think twice, act once, do your diligence, and ultimately you have to believe in what you're investing in. And as Warren Buffett has said over and over and over, if you don't understand it, then don't invest in it. And there's a lot of smart people on this panel. I understand that Americans need to eat, and they need to eat in different ways at different times. And QSR has been there for them for 50, 60, 70 years. It's probably not going away. So we like this particular sector.
Yeah, that's great. And I'm looking forward to learning more in the preceding months how, as you mentioned, private equity becomes more democratized in terms of getting access to it. And I'm sure it's going to come to us in various structures that are going to make it a little bit easier for the middle market investor to get a better sense of what it is or if it's appropriate for he or she. So it's 4:46, so I believe our time is coming to an end. I want to thank our panelists for a very interesting conversation about utilizing alternatives, the pitfalls, specifically private equity. I learned a lot from Brian, and I continue to. And more importantly, our panelists, Dan, Chuck, and Dan Kay. Thanks for sharing what's happening at your firm, your outlooks, the day-to-day trials and tribulations of managing money and client relationships post-COVID. And I hope next time we're together on one of these calls or we meet face-to-face once again, we're in a better place to share a coffee or a cocktail and look back on this and say what a time it was. So again, I want to thank Brian and Triton Pacific Securities for sponsoring the panel and all of our panelists for contributing to a great panel about alternatives. So we're going to transition two things. We're going to, if you want to see FP credits, send an email to Paulina at icsummits.com. And then finally, you will all have just received another email that will take us to our virtual happy hour that will end our day. Hopefully I see you there. And thanks again, panelists.